Welcome, everyone, to today's Explainer. I am absolutely thrilled to have you here because honestly, we are looking at one of the most fascinating mysteries in modern business today. I mean, think about the most valuable companies in the world right now. Their immense worth, it isn't locked up in physical factories or giant warehouses or fleets of delivery trucks. Not anymore. Their true power comes from assets we literally can't even see or physically touch. We're talking software code, brand reputation, patents, customer loyalty, the whole shebang. So today, we are decoding the wild world of intangible assets and figuring out exactly how we measure them when things go wrong, specifically looking at the accounting standards ASSB 138 and ASSB 136. It's a journey into the invisible drivers of corporate valuation, and it is going to be a lot of fun.
Okay, let's dive into this. Don't worry, we're breaking this dense accounting rulebook into a clear, logical life cycle. We'll start with the value gap mystery, define intangible assets, look at research versus development, cover amortization and measurement, tackle the impairment test, and finish up with cash-generating units.
Section 1. The value gap mystery. Book value versus market cap. There's this massive tension right now between what the stock market sees and what accountants are actually legally allowed to report. And that brings us to the fundamental question we have to ask right out of the gate. Why is there such a massive gap between a company's book value and its market cap? If you look at, say, a major tech company, the stock market might say they're worth hundreds of billions of dollars. But if you look at their actual book value, their net assets on the financial statements, it's often just a fraction of that amount. So what gives?
Well, the answer lies in incredibly strict recognition criteria. It's a direct consequence of the rules. The market obviously values a brilliant team of engineers, right? But accounting standards strictly prohibit you from recognizing human resources, like workforce skill and knowledge, as an asset on the balance sheet. No way. You also cannot recognize internally generated brand names or customer loyalty and satisfaction. The rules basically force accountants to act like strict detectives looking for hard, verifiable clues. If the evidence isn't perfectly objective, that asset stays completely invisible on the books, which completely widens that gap between book value and market cap.
Section 2. Defining intangible assets. The rules of recognition. If we can't recognize a brilliant workforce, what actually makes an invisible asset legally recognizable? Under Standard ASB 138, or IAS 38, the definition is ruthlessly precise. It defines an intangible asset as an identifiable, non-monetary asset without physical substance. This strictness, it's a deliberate guardrail. It's there to stop companies from just inventing magical numbers to inflate their worth.
Now, what's really interesting about this slide is breaking down those three conditions. First, it has to be identifiable, meaning you can separate it, sell it, license it, or it comes from a legally binding contractual right, like a broadcasting license. Second, it's non-monetary, so it's not just a pile of cash or a loan receivable. And third, it lacks physical substance. Think about your smartphone for a second. The physical device is just property, plant, and equipment, but the software app running inside it, that lacks physical substance. The true intangible asset is the code, not the glass and metal you're holding in your hand.
Section 3. Research versus development. The birth of an asset. Let's look at how an internally generated asset is actually born. There is a really sharp critical contrast between researching an idea and actually developing it. The research phase happens early on. It's that original planned investigation where you're just trying to gain new scientific or technical knowledge. Because it's so uncertain at that stage, money spent here is always, literally 100% of the time, treated as a sunk expense. It cannot be capitalized. But once you transition into the development phase, meaning you're now applying that research to a solid plan before commercial production, that expenditure finally holds the potential for real, recognized value as an asset. But only if it meets specific criteria. And here they are. To capitalize development costs, you must clear these 6 unforgiving hurdles. You've got to prove technical feasibility, show a true intention to complete it, and demonstrate the ability to use or sell it. On top of all that, you have to prove probable future economic benefits, actually have the resources available to finish the job, and be able to reliably measure the cost. Miss even a single one of these, that money vanishes straight into the expense column. Section 4. Amortization and measurement. The useful life. So our asset made it onto the balance sheet. Now we measure its value as time marches on. Basically, these assets face one of two timelines. Finite assets, like say a 5-year software license, slowly drain their value. They are systematically amortized on a straight-line basis, usually down to a zero residual value. On the flip side, indefinite assets, like acquired goodwill, are totally immune to amortization. We just can't foresee an end to their cash-generating ability, so they live on indefinitely, unless, of course, they get sick, which means they have to be tested for impairment annually. And this brilliantly illustrates how this works in reality. Take a massive Australian retailer like the Coles Group. Their accounting policies show exactly how a major corporation handles this. For their licenses and software, things with finite useful lives, they carry them at cost less accumulated amortization. But their goodwill, they consider that to have an indefinite useful economic life. It is not amortized at all. Instead, it gets tested every single year for impairment. Section 5, the impairment test, sickness and decline. What happens when an asset's expected economic benefits take a turn for the worse? We bring in standard ASB 136, or IAS 36. Let's define impairment clearly. It's the amount by which the carrying amount of an asset exceeds its recoverable amount. Think of the carrying amount as the sheer weight the asset holds on the company's books. If that weight is heavier than what the asset could actually recover out there in reality, either by selling it or keeping it in use, then the asset is officially impaired. It is a mandatory downward adjustment. It's basically accounting's way of forcing a reality check. But here's the thing. While indefinite assets are tested annually, standard assets only face the impairment test when specific red flags appear. You don't just run these tests for the fun of it. These indicators can be external, like a sudden drop in market value, adverse economic changes, or spiking interest rates. Or they can be internal, like evidence that your software is suddenly obsolete, or maybe there's physical damage, or economic performance drops way below budget. When those red flags start waving, you run the test. Section 6, Cash-Generating Units, Visualizing the Math. Now we solve the puzzle of how we test for impairment when assets don't generate cash entirely on their own. Let's move to the math and see how this builds step by step. Let's say we have a shared corporate asset, like a $300,000 headquarters building, that needs testing alongside our smaller units. We have 3 cash-generating units, A, B, and C, totaling $1 million. To test everything fairly, we allocate that $300,000 building pro rata across the units. A gets 20%, B gets 30%, and C gets 50%. That gives us our new fully loaded carrying amounts across the board. Now we are officially ready for the test. Here is the moment of truth. Comparing the new carrying amounts against the recoverable amounts. Unit B, it's totally safe. Its recoverable amount of $420,000 easily beats its new $390,000 carrying weight. But A and C, they are in trouble. Unit A falls short by $10,000 and C falls short by $50,000. Both of these units are legally impaired. So the crucial point is $60,000. That is the total combined impairment loss for the company. 10 grand from A and 50 grand from C. That $60,000 must be recognized immediately in profit or loss. It is a very real hit to the financials, completely driven by these strict rules of checking the reality of our invisible and sometimes shared assets against their book values. Which leaves us with this final thought. We have seen just how strict the rules are for recognizing and measuring the intangibles that drive today's businesses, right? Research is expensed, internal brands are totally ignored. So as the digital economy continues to absolutely explode and these intangible assets become even more central to corporate success, how might future economic shifts further widen that gap between these rigid accounting rules and the true market value of modern businesses? Are our current balance sheets actually capturing reality, or are they just a conservative shadow of it? Think about that. Thank you so much for joining me for this explainer. Keep questioning the invisible assets all around you, and I will catch you next time.